Welcome to Illuminati Silver. We tell you the truth about silver. Today is Monday, the 10th of August 2020. And in yesterday's video entitled $50 Silver? Yes, but not in 2020, we pointed out a significant number of tailwind catalysts that will continue to propel precious metal prices, and especially gold and silver, forward and higher. One of those catalysts we mentioned were, quote, thirdly, equity markets generally are not that far off all-time highs, and this is always a concerning area to be in, especially when earnings for most businesses do not reflect the high price-to-earnings ratios such companies currently command. These monies will eventually find another home, unquote. Now today we wish to address this in relation to an article published by Bloomberg pointing out that the high Nasdaq price-to-earnings ratio of 36 when compared with a 10-year average of 22 either suggests that correction is in order or that our way of lives will change sufficiently post-COVID-19 that we will almost exclusively work from home and even stay there for our leisure activities. Now, admittedly, whilst we do believe that people's habits will change and have changed, we suspect that a correction will eventually have to occur. Now, that may be some months down the road against even higher equity prices, because current levels of stimulus are keeping markets propped up. But when that stimulus is eventually eased, and one day it will be, I know you'll be told by pumpers and everyone else, it will go on indefinitely and it will eventually result in the complete collapse of world economies. Well, let's wait and see. We've heard it before. But when that stimulus is eventually eased, then when equities are 50% higher or more than their price-to-earnings ratios dictate they should be, then that correction will actually occur. So let's take a look at the article published by Bloomberg in question, and then we shall comment on it afterwards. Bloomberg article dated August 8th, 2020. Headline: Nasdaq valuations say you'll be stuck at home for a long time. In trying to explain the most baffling fact of 2020's topsy-turvy markets, how tech valuations have swollen to bubble-era extremes even as a pandemic rages, people cite two things: Federal Reserve largesse and hopes the coronavirus will be quickly contained. But another slightly scarier theory exists as to how the value of companies in the Nasdaq 100 has expanded by $2.9 trillion in this of all years. It's that the COVID-19 crisis's impact, or at least the social distancing strictures it has forced upon the world, will prove to be permanent. While not quite accepted wisdom, it's a view coalescing in the minds of certain market watchers that even if the virus is defeated, the behaviours it has engendered will live on. The idea gets tossed around after weeks like this, in which the tech gauge jumped more than 2% and its price-to-earnings ratio topped 36 for the first time since 2004. Even when things normalise post-vaccine, do we go back to the old ways of doing business, or have we just sort of fast-forwarded, said Rick Weiss, Chief Investment Officer of Multi-Asset Strategies at American Century Investments. The digital transformation initiatives have just rocketed us into the future, and that's going to be the way of the future. So those companies' valuations may be very justified. One way of quantifying how much investors expect of giant technology companies such as Apple Inc. and Amazon.com Inc. is to consider how much it will take for their profits to grow into existing valuations. For instance, the Nasdaq 100's price-to-earnings ratio of 36 compares with a 10-year average of 22. Assuming tech shares sit still, they'd need 3 years' worth of almost 20% annual earnings growth to get multiples back to average. Going by this logic, the market, consciously or otherwise, is doing more than just adjusting for a brutal but brief economic interruption. Rather, it's repricing itself for a more profoundly altered reality, a world in which the urge to limit human interaction squeezes the old economy mercilessly, while hastening the ascent of a digital and mostly automated new one. We're going through a really troubled time right now. It has changed the way we live, said Kim Forrest, Chief Investment Officer at Bouquet Capital Partners. We're learning how to do business in this touchless world, and technology is at the core, enabling it. Signs of lasting change are everywhere. Bankruptcies are piling up, altering the consumer landscape. A survey by creditcards.com found more than 40% of people who spent money on movies and event tickets before the pandemic now plan to spend less. Half of Americans aren't eager to hit a bar, and more than 1/3 aren't excited about sports games or movies, according to a recent survey by Bloomberg and Morning Consult. On the other hand, Amazon had record profits in the second quarter. Apple's products keep selling. iPhones, iPads and Mac computers to people trying to stay connected, resulting in record revenue for the company's June period. Netflix Inc. added 10.1 million paid customers in the last quarter. Wayfair Inc., whose stock has surged 1,000% since mid-March, saw sales rise 84% to $4.3 billion. Habits formed now might lead to some permanent changes, said Anat Admati, Professor of Finance and Economics at Stanford University's Graduate School of Business. Those thrust into remote work settle into new routines. The question is, if they have a choice as the environment gets safer, will they switch back to the old way? Most likely, some of the new habits will stick, including because they may work better in some settings, Admati said. The benefits of digital technology that allow remote work are seen ever more clearly, and so is the staying power of such technology. Tech behemoths now account for 28% of the S&P 500 and make up more of the index than the next two sectors, healthcare and consumer discretionary combined. The largest 5 stocks have gained as much as all the others have lost this year, Bloomberg data shows. Apple is nearing $2 trillion in value. As long as the virus is hovering over us, and as long as there is a belief that the virus could move into a second wave, you're going to be in pockets of the market that have people staying at home more, and where there is growth, and that's it. Those tech names, including the stay-at-home tech names, said Quincy Crosby, Chief Market Strategist at Prudential Financial. That's what keeps people working. Growing 20% a year through 2023 is a lot more than Wall Street analysts expect. They see Nasdaq 100 profits rising 6% annually over the next 3 to 5 years. A lot may depend on growing demand for consumer products. In Morgan Stanley's latest survey of chief information officers published last month, planned tech spending is forecast to post a record drop of 4.4% this year. That means, according to Mike Wilson, the firm's chief US equity strategist, much of the benefit that the industry enjoyed during the pandemic lockdown was likely a pull forward of demand rather than a sustained acceleration, a backdrop that may prompt downward earnings revisions in the second half. Matt Stuckey, portfolio manager at Northwestern Mutual Wealth Management, said tech is a long-duration part of the market. The majority of the value of these companies is much further out than a normal stock, according to Stuckey. If the work-from-home environment persists, there's probably not a good reason why these things would change. Okay, an interesting theory. As we mentioned before this article, we accept that habits will change. but perhaps not quite to the extent, or maybe as quickly to the extent, the article suggests. Human beings are by very nature pack animals, and those of us who've been quarantined these last few months realize how irritating and frustrating it is not to go out and meet and greet friends and family and business acquaintances and socialize generally. We are seeing, in our view, bubbles developing in equity markets once again because of the level of stimulus. Equities could indeed rise even further, but we make it clear, and have made it clear at the start of this year, that we ourselves have sold virtually all of our equity holdings because we cannot see these high valuations as sustainable. Ironically, though, one of the benefits of COVID-19, and it's particularly painful for employees, is that companies have been able to trim their operations by laying off staff and move over to a more tech-based order, manufacture and delivery system, thereby longer-term reducing company costs. This, however, will then leave governments with a headache of how to fund the severe levels of unemployment that will and have ensued. Please do share your thoughts on this matter, as it would be appreciated. Thank you so much for listening, and if you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they're published. Not forgetting that we update our Richard and Greg channel every few days, and we would appreciate it if you would subscribe to that one too. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.